In our previous video, we explored the rapid growth of technology and state-based decentralized networks, and how they are redefining value transfer and payments. In this video, we'll delve deeper into a fundamental question. What is money? What does it represent? How is it actually used? And how does it get created? Let's start by exploring the origins of money itself. Money serves three primary functions. It is a unit of account, a medium of exchange, and a store of value. Throughout history, it has taken many forms, including grain, shells, metal, and paper. A common belief is that money evolved from barter systems, where goods were directly exchanged in order to simplify the complexity of trade. Precious metals like gold and silver were favored due to their intrinsic value, durability, divisibility, and portability. But this belief is likely flawed. Money existed in various forms for thousands of years before coins were even invented. Ancient societies had sophisticated banking systems based on grain storage, and used early forms of money for taxes and religious offerings. In fact, there's no historical evidence that a pure barter economy ever existed. Trade has always required money in some form. These early forms of money later evolved into coin-based systems. The earliest coins were made from electrum, a natural alloy of gold and silver, and played a crucial role in funding military campaigns and fueling the expansion of empires. But even long ago, the value of these coins often exceeded the intrinsic value of the metals they contained. This discrepancy highlights a key aspect of money. Its value derives not from the physical materials, but in the trust of the authority that issues it. As it turns out, tying the value of coins strictly to precious metals could actually restrict economic growth. Countries with abundant coinage often prospered as economic growth and decline were closely linked to the availability of gold and silver. That's why debasement, or reducing the precious metals in coins, did not always harm the economy. In fact, during the Middle Ages, countries with the most economic growth were also the ones with the most devalued coins. Commodity-based currencies also introduced a fundamental problem. Money cannot be both a commodity and a measure of value. Gold and silver as commodities have fluctuating values, which makes them unsuitable as stable forms of money. Eventually, paper money was introduced in Eastern empires. This served as a lighter alternative to coins. The paper itself held no intrinsic value. Its worth was derived purely from trust in the issuer. Paper money greatly facilitated trade and helped develop modern banking, where banks issued promissory notes based on trust. The widespread adoption of paper money proved that true value was not derived from gold or silver reserves, but in the collective trust of the financial system. Money was first used to measure and settle obligations to governments and cultural institutions. Prices were based on the weight of barley, creating a system of proportional value. Silver was often used as a standard unit of account, rather than as a means of settlement. Instead, money was created to settle debts, and these debts became the foundation of economies. In this context, money serves as a standard measure of abstract value and a universally accepted means of payment. Its value is tied to a unit of account, essentially acting as a promise to pay. It follows that money is a socioeconomic construct, rooted in social relationships, not in commodities. Its acceptance depends on social credibility and represents a claim against the issuer. In modern economies, banks play a pivotal role by facilitating the flow of claims and obligations. Commercial bank deposits are debts owed to depositors, backed by government bonds and private debt. Similarly, government-issued currency represents public debt that is not expected to be repaid directly. Instead, governments accept their own money for taxes and public fees. In commerce, we exchange commodities for credits. There is no actual medium of exchange. A sale earns a credit, and a purchase creates a debt. Credit is not just a byproduct of transactions, it is definitive purchasing power. The advent of Bitcoin and other cryptocurrencies have introduced a new form of digital commodity money. Valued for its rarity and durability, Bitcoin mirrors the characteristics of traditional commodities like gold and silver. However, unlike traditional money, Bitcoin does not involve both a creditor and a debtor. In that respect, trading Bitcoin resembles the exchange of a commodity. While Bitcoin clearly has monetary value, it shouldn't be considered money in the formal sense. Stablecoins like USDT and USDC function more like bank money. USDT, for example, represents credit on the Tether platform, similar to a bank deposit, operating on a decentralized ledger but managed centrally. Using USDT as money involves trusting Tether's creditworthiness. DeFi has led to the creation of smart contract-based stablecoins like DAI and Liquidity USD. These stablecoins use cryptocurrency as collateral to issue stable token assets. Smart contracts manage these stablecoins autonomously, creating a new form of decentralized money. Trust in the value of any currency, whether issued by governments, individuals, or smart contracts, depends on the reliability of the debt issuer. So, how is money efficiently issued? In most cases, credit is provided against collateral like securities, commodities, or other liquid assets that can be seized in the event of borrower default. Collateral secured credit reduces risk and leads to lower costs and shorter loan duration. These transactions are crucial to global markets, boosting capital for investment and economic growth. The overall secured credit market is immense, and quality collateral is essential to maintaining stability in the global financial system. In the traditional finance world, collateral secured transactions vary in size, duration, and risk. They include cash borrowing, repurchase agreements or repos, securities lending, and derivatives trading. Cash borrowing typically involves secured loans using assets like mortgages, vehicle loans, or credit card debt. Financial institutions often securitize liquid assets into marketable securities, such as bonds or collateralized debt obligations, which are then divided into tranches with varying risk levels. Repos are short-term loans where assets are sold and later repurchased. Repos allow institutions to borrow efficiently while earning returns on surplus cash. These transactions are a primary mechanism for banks to leverage liquid assets and manage cash reserves effectively. Central banks also use repos to control interest rates and manage liquidity. Securities lending involves short-term loans of stocks or bonds against collateral. This practice is essential for short positions, hedging, and maintaining global market liquidity. Derivatives trading, including interest rate contracts and credit default swaps, is used to hedge price movements and increase market exposure. These various types of collateral-backed TradFi transactions have different complexities and different risks. In other words, they lack interoperability, and that has led to an inefficient system. It's not just the different types of transactions that lead to inefficiencies in using collateral. It's the collateral management process itself. Let's look at how this works. First, collateral must be verified. This requires ensuring its existence, condition, and value, particularly for intangible assets within third-party designated accounts. Another factor that must be considered before an asset is used as collateral is its liquidity, or the ease of converting it into cash. Next, collateral is perfected by establishing and proving that you have a priority claim over an asset. This is often done by filing a lien and then demonstrating it's in place. Collateral is typically registered with custodians to ensure it's traceable and to recognize who owns it. It's common to reuse collateral within financial markets, a practice known as rehypothecation. However, this can create confusion about who actually owns the asset and who has ownership priority if a default occurs, as we've seen in past financial crises. The last step is to enforce collateral interest by seizing and then selling assets in the event of a default. This process is often long and expensive, typically leading to lower returns because of limited time and market liquidity. In this video, we've learned that despite its many forms, money is not a commodity. It's an accounting tool. Money measures debt, and much of that debt is backed by collateral, which has become the primary factor affecting market liquidity. The strategic use of collateral in secured credit transactions, serve as the prevailing catalyst for global economic growth and stability. In our next video, we'll look at how state-based networks can streamline collateral use, credit issuance, and ultimately, money.